Welcome back to the Deep Dive. We've got quite a mix of sources today looking at some big strategic moves, especially in Korean finance and related industries.
Yeah, it's really a fascinating set of pressures. You've got companies making these huge financial commitments. Some look smart, others maybe a bit questionable.
Right, dealing with digital transformation demands on one hand, and then, tricky debt situations and global regulations on the other.
Exactly.
So our mission today is to give you a quick but hopefully deep look into these high-cost moves and the risks involved. We're talking talent wars, complex debt shuffling, all that.
It's about understanding the real price of staying competitive right now.
Okay, let's unpack this. First up, the digital talent arms race. It seems Korea's five major banks, KB Kookmin, Shinhan, Hana, Woori, and H Nonghap, are really doubling down on Samsung's SSAFY program.
Oh, absolutely. It's more than just hiring. It's like a strategic alliance. The banks realize they just can't train the software and AI talent they need fast enough internally.
So they're turning to SSFY, the Samsung Youth Swino I Academy.
That's the one. And the money involved is serious. Since kicking off in June 2023, they just added another, what was it, 2.5 billion KRW?
Yeah, bringing the total bank contribution to 7.5 billion KRW, just for operations.
It's a huge sum. And remember, Samsung itself funds a lot the monthly stipends for students, the mentoring. It's a big CSR push for them, too.
A million KRW a month,
Oh.
right, plus consulting.
Yep. And you can see why the banks keep investing. The sources say over 1,300 SAFEY grads have landed jobs in finance.
And a big chunk at these five banks specifically.
Around 760, yeah. And look at the trend. The number of grads going into finance jumped from like 33 in the early days to 139 more recently.
Wow. So the banks are basically becoming dependent on this external pipeline. It's like outsourcing the core training for their future tech workforce.
Pretty much. It saves them a ton of time and effort. And the training is practical, too. Second semester, students work on projects pitched by the banks themselves.
Real-world stuff.
Exactly. Things like AI for financial services, accessibility tools, data analysis, stuff the banks actually need.
Here's where it gets really interesting. Shinhan Bank's running fintech hackathons with these students. KB Kookmin's doing developer workshops. They're integrating them directly.
Right, and the banks seem happy. NH Nong I praised the grads for having solid technical skills. So it's seen as a win-win. Helps youth employment, boosts Korea's tech scene, and solves the bank's talent problem.
It makes sense, but relying so heavily on one external program, isn't that a risk? What if SAFY changes, or the banks start fighting harder over the same grads?
That's a valid long-term concern. There's definitely a dependency being built, but right now, the efficiency seems to outweigh that risk. Trying to build this kind of program themselves would be, well, way more expensive.
So for now, it's the best path forward, even with potential future vulnerabilities.
Seems like it. Digital survival isn't cheap.
Okay, shifting gears now. From building future talent to maybe managing past issues, let's talk about DL Chemical. They did something pretty unusual with their debt.
Yeah, very unusual. They paid back a 100 billion KRW loan from Woori Bank super early.
Even though the terms were great, low interest, like 4%, and nearly a year left.
Exactly. Paying off cheap debt ahead of schedule. That definitely raises eyebrows, especially when you look at what they did next. They immediately issued 250 billion KRW in perpetual bonds, which are, technically debt, but treated like equity on the balance sheet.
Ah, the hybrid securities. But wait, the interest rate on those was higher, wasn't it?
Significantly higher, over 5%. So they replaced cheap debt with expensive capital, basically.
And the official reason was just financial structure improvement.
Yeah, which sounds nice. But if we connect this to the bigger picture, DL Chemical's debt-to-equity ratio was through the roof, like 374%. Mostly because their joint venture, Yeocheon NCC, is struggling badly.
So the perpetual bonds are an accounting fix. Because they count as equity, it instantly makes that debt ratio look much, much better on paper.
Precisely. It's financial engineering. Window dressing, as you called it earlier.
But is there any other reason they might do this? Or is the market view just cynical, like this is purely tactical?
The market is definitely leaning towards tactics. Think about the Yeocheon NCC restructuring talks. Creditors, the banks, are pushing DL Chemical for more support, maybe even a debt-for-equity swap.
Which DL Chemical wouldn't want.
Right. So by paying off a big bank loan like Woori's and replacing it with bond debt held by, dispersed bondholders, they potentially weaken the negotiating power of those main creditor banks.
Yeah. So they pay more interest now to have more control later. to reduce the bank's leverage over them in these restructuring talks.
That seems to be the prevailing theory. It's a costly way to gain strategic advantage.
Especially given the history, right? Didn't DL take huge dividends from Yochen NCC for years?
Reportedly over 2 trillion KRW. And now that Yochen needs help, they seem reluctant. So this move feels, to some observers, like they're prioritizing leverage over cooperation with their long-term banking partners.
Paying more to avoid helping more, essentially. Risky. Okay, from tricky debt moves to the perils of going global, let's look at Hanwha Life. They just bought a majority stake, 75%, in a U.S. brokerage, Velocity Clearing. Big move into North America.
Huge move, finalized in July, but then, bam! Just a month later, the U.S. regulator, FINRA, hit Velocity with a $1 million fine.
Ouch. Talk about buyer's remorse, maybe. What was the fine for?
Massive compliance failures. Basically, Velocity wasn't properly monitoring for market manipulation. Get this. Their system flagged 150,000 alerts over a few years.
Okay.
And they apparently closed 147,000 of them with zero investigation. Like, just clicked ignore.
You're kidding. 98%. How does that even happen?
Understaffing, it seems. FINRA found they initially had only one person doing surveillance. One.
One person for 150,000 alerts. No wonder.
And the backlog is insane. Still over 5 million suspicious alerts needing review. That's a huge ongoing problem.
So the big question, did Hanwha Life know about this mess during due diligence? This was a landmark deal for them, first big Korean insurer to buy a U.S. broker.
It really puts their risk assessment under scrutiny. Hanwha says they were aware of the issue generally, and they argue no actual illegal trades happened. They're staffing up now, of course.
But still $1 million fine right off the bat, plus the cost of fixing that mess. And this hits them when their domestic finances are maybe a bit stretched.
That's a context. Hanwha Life's KICS core capital ratio, that's the key solvency measure in Korea now, is reportedly around 59.5%.
Which is low compared to peers.
Yeah, it suggests less of a buffer to absorb unexpected hits compared to other major Korean life insurers. So this fine and the future cleanup costs, it's definitely not ideal timing for them. Adds pressure.
Okay, so we've seen costly talent acquisition, expensive debt management, and painful regulatory fines. Lots of reactive spending. But there was one contrasting story, right? More proactive.
Yeah, a brief mention of Hana Financial Group's annual Modu Hana Day, their big CSR campaign.
The 15th year, I think. Chairman out doing kimchi sharing for charity, that sort of thing.
Right, standard CSR stuff. But the interesting detail was how they delivered the kimchi. They specifically used the Silent M taxi service.
The one run by deaf drivers.
Exactly. That small detail turns a simple donation into something more thoughtful about inclusion. It's smart PR.
It's a good point. Low cost, high impact on reputation. A real contrast to Hanwha having to shell out $1 million for a compliance failure or DL Chemical paying higher interest rates.
Totally. One is investing in goodwill. The others are paying for, well, either past problems or strategic maneuvering. Different kinds of costs.
So wrapping up today, we've seen some high stakes. Billions spent securing tech talent via SSAFY.
A costly but seemingly necessary bet on the future.
Then DL Chemical, using expensive perpetual bonds, possibly to manage creditor relationships more than just fix the balance sheet.
A complex, maybe risky financial play.
And finally, Hanwha Life, learning about the immediate costs of global expansion when compliance isn't perfect. That fee-fi and rye, fine.
Yeah, a sharp reminder that international deals come with international liabilities.
The thread connecting all this seems to be that just having money isn't enough anymore.
I think that's right. It's about integrated capabilities. You need the tech know-how, like with SSFY. You need rock-solid legal and compliance, which Hanwha may be underestimated. And you need the operational discipline to avoid these kinds of creative but costly debt solutions.
Which brings us to a final thought. We talked about DL Chemical using perpetual bonds, an expensive technical fix for their debt ratio. It makes you wonder, and maybe this is something for you, the listener, to consider. How long can companies keep using these sorts of financial maneuvers, focusing on the appearance of health, before investors start questioning the underlying operational reality? Especially when core issues like restructuring that troubled joint venture seem to drag on. When does that faith start to crack?
Definitely something to watch. These fixes can only paper over things for so long.
We'll leave it there for this deep dive.
We'll be back soon with more insights.
Thanks for joining us.
7 minutes, 45 seconds, approx. 1,300 words at 168 WPM.